Well, our next guest sees a bullish signal in the bond move. Savita Subramanian is the head of U.S. equity and quantitative strategy at Bank of America Securities. Savita, great to have you with us. Welcome to our new set here at Studio B in the NASDAQ.
Yeah, thanks for having me.
Guest ever.
Quite an honor. I know.
Not an accident.
So what is that sign, that bullish sign in the bond market?
The bullish sign in the bond market. Well, I mean, 10-year yields are rising, and I think everyone's interpreting that, including myself, as a lot of different factors like supply, demand. There's a lot of supply coming online, and then meanwhile, China, the Fed, BOJ are no longer buying. So that's bearish for bonds. But I think it's also potentially a nascent sign of something positive happening, which is that companies are now refocusing on efficiency and productivity rather than juicing up earnings through levered buybacks and, cheap financing costs. And what surprises me is that when you look at the equity risk premium and multiples on stocks, you tend to see investors willing to pay a higher multiple for companies that are actually focused on efficiency. And companies are now finally focused on efficiency, and they have new tools. They have AI, they have automation. So I actually think there are a lot of reasons to be bullish about growth in the U.S. rather than just yields are moving up and this is like death to equity. So
I think the last time you were here on Fast Money, you had said something to the effect of, I'm the most bullish I've been in forever.
In years, at least since the global financial crisis. Because I think that what we know now is, maybe we don't see as strong of returns from here, but we see more real returns. And I think that we're past this experiment of QE and zero interest rates and negative real rates and all of this really kind of unnerving stuff that has been hard to allow us to actually value equities appropriately. We're now at a point where earnings are still positive. We're seeing companies actually, focusing on labor efficiency because labor inflation is showing up. So I think that we're at a point where productivity, which is something that nobody really thinks about anymore because we didn't really have it for a while, that's actually going to be driving the next leg of the bull market.
It's interesting. You talk about no more free money. Companies have to be more efficient, which is a great thing. I agree with that. But at what point, if any, does this lag effect of higher 18 months of higher rates kick in?
I think it's already starting to show up. But I think what's interesting is if you look at the S&P 500, and this is not true for any other equity benchmark, companies have actually gotten very disciplined about leverage. And I think that's the lesson that everybody learned in 2008. And even consumers have gotten disciplined. So if you look at the U.S. consumer and the U.S. corporate, they've basically locked in long-dated fixed rate debt obligations. So this is all going to be bad and net negative, but there's a while to figure out how to grapple with this. And then moreover, I think what's interesting is that if you look at sectors like industrials and energy and financials, companies that usually expand capacity during bull markets, these are companies that were denied capital for the last 10 years and have gotten very, very lean and disciplined and are now at a better position to handle a higher interest rate environment. So I don't know. I look at the market right now and I look at even, the average consumer. And back in 2008, there were a much higher percentage of homeowners that had ARMs or, adjustable rate mortgages. Today, just 15% of homeowners have adjustable rate mortgages, which is a whole other problem because now nobody's willing to walk away from their homes. And that's why we have this shortage of single family. So, again, I don't think it's just gravy forever, but I do think that we're at a point where we have some visibility on what the Fed is going to do. They've already done a lot of the hard work. We're at 5% on short rates. I think we should be happy about that because that means we have some latitude to ease our way in the next downturn. And then on top of that, we've got consumers that are still relatively well capitalized. Maybe not as well capitalized as after they got a bunch of free money, but they still have relatively solid balance sheets.
So let me ask you something, just to touch on something you said, which is about greater efficiency to come, right? We saw Meta, I know you don't talk specific stocks, but we saw the effect of the year of efficiency, and we've seen it for a number of companies. But we haven't seen it from a lot of others yet.
Right.
Do you think that is still a really meaningful amount of juice, I guess,
runway
for the market?
Yeah, I think there is still a lot of room to get efficient. I fully expect to be replaced by ChatGPT or a robot at some point, hopefully not for a while, but I need to put my kids through college first. But, I think that there are aspects of corporates that can be made much more efficient, through, especially the services industry. You're seeing this with restaurants. Our analyst on restaurants has been writing a lot about, what the new kitchen looks like. There's a lot less people and, a lot more automation. And I think there's room to do this across the board.
That doesn't bode well for you, Guy, by the way. The kitchen with less people in it, and just you like to cook, right?
I do.
I'm
worried.
You worked at Shake Shack.
Yes.
I worked at Pizza Hut.
Yeah.
I'm all over the place. Anyway, please continue.
But no, I do think it's a longer-term story. I think AI is part of it, but not all of it. I just think that we've had this wonderful period for the last 20 years where we didn't have to worry about labor inflation. We could just move stuff to cheaper areas of the world. And now we're moving stuff back to the U.S., but we're thinking about how to do things, how to do more with less, which I think is really bullish for margins, for multiples. I mean, investors are much more willing to pay a high multiple for a company that has improved their operational efficiency than a company that just borrowed a bunch of free money and bought back a bunch of shares.